Okay, so we're going to have a look at marginal costing, which is a decision-making tool used in management accounting. So, marginal costing is all to do with something called contribution and break even. Contribution is the selling price minus the variable costs of production. Now, contribution is something that's very, very important, something you really, really need to know, and is used in decision making in all of management accounting. So each unit is contributing to paying off fixed cost. If you take the selling price, you take away the variable costs, then all that remains is the fixed costs. So your contribution minus your fixed costs will give you your profit. So what are the differences between fixed and variable costs? Well, fixed costs are costs that remain fixed for a period regardless of output. So no matter how many products you make, the cost will remain the same. So the examples we've got there are things like rent, salaries, depreciation, insurance, and finance costs. If you think it through, rent is definitely a fixed cost. Now, if you pay your rent to your landlord, they don't care whether you make one product in the year or a million products in the year. They're still going to want you to pay the same amount of rent. So a fixed cost remains the same regardless of how many products that you make. Now, that's the assumption that we make, that they remain the same. And you can see on that graph that line, that horizontal line there, that represents our fixed costs. And as output would increase, then the fixed costs do remain the same. However, that is true to an extent, but at certain points, your output will exceed your fixed costs. And by that, I mean at certain levels of output, your fixed costs will increase. And we call these stepped costs. Been in the exam a few times, so it is worth remembering that one. So let's use rent again as an example. So it remains the same for a certain level of output. And then when we get to a certain point, our output exceeds that fixed cost and we have to increase our fixed costs. That'll be things like a warehouse. At a certain level of output, your warehouse will get full and you will need another one. So you will see a step up in your fixed costs. For the majority of AQA questions, fixed costs do remain the same for a year or longer. So fixed costs, as we say, do increase in steps, but we've also got variable costs. Now, variable costs sometimes is actually called a marginal cost. Variable costs essentially increase with the output. So every time you make one extra unit, your costs increase. Now, in reality, as you buy more, you'll spend less because if you buy in bulk, then the cost will go down. But again, for the purpose of the AQA exams, your variable costs will remain fixed to a unit price throughout the year. Selling price, again, we're going to make the assumption that selling price will remain constant during the financial period. But again, in a practical situation, we may alter our selling price throughout the year. Now, you're going to be asked to calculate selling price using either markup or margin, two of the accounting ratios. Now, remember, if using markup, to add a percentage to the cost. For example, a cost of £50 with a markup of 20% means a selling price of £60. 20% of 50 is 10. Add that on to find your selling price. If it's margin, then the cost will be a percentage of the selling price. So, for example, a margin of 20% where cost is £80 means a selling price of £100. Now, we're going to use this concept of contribution and break even to make some decisions. So we're going to look at break even itself, at pricing, at special orders, make or buy decisions, limiting factor, and dropping a product. So these are all decisions that we can make using marginal costing as a tool. Now, there are some equations that you need to learn. You're going to learn about break-even point, which is fixed costs divided by contribution per unit. That answer will be in units, as it says there. Make sure that you always write units after your answer. Your turnover at break-even point is units times selling price per unit. We can also work out how many products we need to make in order to hit our target profit. And that's simply fixed cost plus target profit divided by contribution. Our margin of safety can be calculated as target unit of sales minus break-even point in units. Again, that answer will be shown in number of units of production. And using that formula, you can then work out your percentage of margin of safety, which is your margin of safety in units times 100 divided by the target units of sales. They might not mean anything to you this very second, but they are definitely worth learning. So let's just talk about that margin of safety. So margin of safety is an important calculation because it measures risk. A high percentage of margin safety shows a low risk for the business. So, for example, a 60% margin safety shows that sales forecasts can fall by 60% and the company will still be able to break even. A low percentage margin safety shows a high risk for the business. So you don't want your sales to drop too much, otherwise you'll fall below break even, and that means you are making a loss. So Emma has got a target number of sales of 4,500 units. She's calculated a break-even point to be 3,000 units. Therefore, her margin of safety is 1,500 units, or 33.33% of her target sales. So that means Emma can see her sales drop by up to 33.33% before she starts making a loss. So very important calculation for us. Obviously, when we predict our sales at the start of the year, it's never going to be entirely correct. So we want to make sure we've got a decent margin of safety before we start production. So break-even charts. So a break-even chart will show us how many products we need to sell to neither make a profit nor a loss. It's where our total revenue equals our total costs. Now, these can be put together relatively straightforward. Just a load of lines on a graph. All we do is we plot our fixed costs. You can see that as the horizontal line there, as we talked about before. We can plot our variable costs, which increase with the units that we produce. We can then plot our total costs, which starts at the fixed cost line. Remember, even at zero level of production, we still have those fixed costs. So our total costs will start partway up this axis. And it will follow the same gradient as the variable cost there. And then we plot our total revenue. Obviously, revenue increases the more that we sell. And the point at which our total costs meet our total revenue, we see our break-even point. That is, how many products do we need to sell to neither make a profit nor a loss? So at £150,000 worth of costs, we also make £150,000 worth of revenue. So we have neither made a profit nor a loss. And at that level, at that point where the two lines meet, our output is 1,000 units. So that is our target to aim for. How many products do we need to sell in order to neither make a profit nor a loss? And you can do this at the start of a financial year to see if a product is worth making. So So if you've got a product, I don't know, let's say 1,000 products is glow in the dark cat collars. Don't know why, but glow in the dark cat collars. I've got a cat. Sometimes it jumps out at me, scares the life out of me. If it had a glow in the dark cat collar on, then I'd be able to see it and it wouldn't jump out at me. All right, it's a good idea. But if this is my break-even chart for glow in the dark cat collars, am I really going to be able to sell 1,000? Are there 1,000 people daft enough to want to buy one of these? If yes, then I can say, great, that's how many I need to make to break even. Hopefully I can sell some more and make a profit. If my market research shows that less than 1,000 people want to buy these cat collars, then it's not worth making, because I know that anything below 1,000 units will make me a loss. Now, obviously, these are relatively straightforward to draw out, but they can take a bit of time. So we can use a formula as well, which we will look at very shortly. However, little tip for those of you who want to be accountants in the future: if you ever show a graph in a meeting, non-accountants are well impressed. So always stick one of these onto your PowerPoint for non-accountants, and they will be blown away by your use of financial data. So that's the information you need to plot a break-even graph. You need your fixed costs, your variable costs, your selling price per unit, and the maximum output that you can make, so that you know what to plot on your x-axis. You'll then plot the graph using various different points of output, and you can then put that into a graph. And Robert's your mother's brother. So we're going to look at making some decisions using contribution and break even. So the accountant could use contribution to decide whether to continue making a product or not. The thing that we want to make sure of is that the product is making a positive contribution towards the fixed cost. Anything that's making a negative contribution is loss making, and we may decide to drop the product. Not always, but we might decide to drop it. Here is an example. We've got 3 products, A, B, and C. Profit or loss on each one is shown. We've got our sales, we've got our costs, and our profit or loss. At the moment, C is making a loss of £25,000. If we delve into that a little bit more, we can see that costs are split 3/5 variable and 2/5 fixed. Now, when we split those costs up, we can see that C actually makes a positive contribution of £85,000. Its fixed costs of £110,000, those are what are causing it to make a loss. However, remember that fixed costs remain regardless of how many products you make. So if you stop making C, you've still got to make that product. Now, our total profit or loss, if we make all 3 products, is £675,000. If we stop making C, our fixed costs still remain at £430,000, and this time we'll only have the contribution from products A and B to pay off those fixed costs. So our profit would only be £590,000. The difference between making all 3 and dropping C is 85,000, which is the contribution that C provided. So unless you can get rid of those fixed costs, you would need to keep making C. Now, you can also state that a product can make a negative contribution, but you would still make it. A product that makes a negative contribution would not really be made as it is making you a loss. However, if that product is part of a set, then you perhaps need to continue making it. So, for example, if A was a hat, B was gloves, and C was a scarf, and the scarf made you a loss, you might still need to make it, so otherwise you might not be able to sell the hat and the gloves. So there are things to think about as well as profit. However, in this example, we can see that profit is higher even though we're making this loss-making product. Another way we can use contribution is through looking at key or limiting factors. Limiting factors occur when there's a shortage of a key resource. Now that's in your exam going to be either labour or materials. So you either don't have enough staff hours or you simply can't buy enough material to make all of the products that you want to make. Now, very, very important in this part is calculating the contribution per limiting factor. You can work out the contribution for each product and see which one's highest, but it won't tell you which is the best product to make. See why in a second. So contribution per limiting factor. I do want you to think about that at all times. Now, a ranking order will then be produced with the one product with the highest contribution per key factor, giving a ranking of 1. We then produce a production schedule, sometimes called an optimized production plan, which will help maximize profit. So here is our example. We have got a limiting factor in this question, which is material. We can only make 80% of the products, as only 80% of the material is available because of a shortage in supply. Now, if we look at these, each one, we've got products A, B, and C. We've got the output for each one. 5,000 for A, 6,000 for B, 8,000 for C. Obviously, we can't make them all because of a shortage of material. We've then got the selling price and the variable costs for each unit. And we've also got our fixed costs of 90,000. Now, the first thing that we're going to do is work out the contribution for each. We can see A provides a contribution of 10, B provides a contribution of 15, and C provides a contribution of 10. Now, remember, we want to know our contribution per limiting factor. So we're going to look at the contribution per pound of material used for each product. Going back to the previous slide, A used £20 worth of material, B used 15, C used 25. Now, all we're going to do is divide the contribution per unit by the cost of material used for that unit. So £10 contribution, A used £20 of material. So for every pound spent on material, this product is providing 50p worth of contribution. B, it's £1 worth of contribution for every £1 spent on material. And for C, it's 40p worth of contribution for every pound spent on material. So this is telling us what is giving us the best chance of maximizing our income. Which one is providing the most value for money for every pound spent on material? And we can see there that the answer is B. It provides us with a pound's worth of contribution for every pound spent on material. That gives a ranking of number 1. We then rank A as number 2 and C as number 3, simply in the order of value. So don't just use contribution per limiting factor. In this case, per pound of material used. That is then going to allow us to revise our production plan. Our original production plan was for 5,000 of A, 6,000 of B, 8,000 for C, giving us a total of £390,000 to spend on material when we multiply the units by the material cost. Now remember, we only have 80% worth of the materials. which is 312,000. So using our ranking system, we can revise production. Now we're going to make all of B, because remember we've got 312,000 to spend. So we're going to make all of B, which is £90,000, giving us the most amount of contribution per pound spent on material. Our second ranking was A, which is 5,000 units at £20, which is 100,000. So we've still only spent £190,000. So we've got £122,000 to spend on C. Now we can't make the full 8,000. So 122,000 divided by 25 would mean we can make 4,880 units. So we have revised our production plan to use the available materials to provide us with the most profit. We can then calculate the total profit achieved as contribution multiplied by the units made, deduct those fixed costs, and our profit would be 98,800. Do it any which way you want. I promise you that one will always be the highest profit. Go away and have a look at it if you want. Try as many times as you want. So by using contribution, we're able to make a decision about which product is going to provide us with the most profit. The remaining products, the extra, 3,120 products that we need for C, we either can't sell them or we would have to buy them in from elsewhere. Another decision we can make is whether to accept a special order or not. Special orders should be, again, using the concept of contribution to decide whether or not to accept. Now, you want to make sure that every time you accept an order, it is making a contribution towards fixed costs. And then if you've got any spare capacity, so if you get any extra time in your manufacturing process to make this special order. So contribution pricing is used by a wide variety of firms, from hotels to airlines. So sometimes if you go and try and book a flight on the day of the flight, you can usually get it dead cheap. As long as that is making a contribution towards the costs of running the plane, they will let you on. Now, you've got to remember that when you do adopt a policy of pricing for special orders, you give people a lower price than usual, then your other customers might take their business elsewhere or demand the lower price from you as well. And if you start throwing out cheap prices, then your competitors can start a price war as well. So these are just some external factors that we need to think about when making our pricing decisions. Here's an example. We've got Terry. He sells blankets, makes each one at a total cost of £20, able to sell them to his customers for £45 each. He's making £25 contribution currently. Terry currently works at 80% production and he's making a profit of £11,000 per year, and he's paid off all of his fixed costs. So everything's working out swimmingly for Terry. But he's received an order from an Irish firm for 200 blankets. They're only prepared to pay £35 per blanket though. So should Terry accept the order? In financial terms, yes, Terry should. He's got that spare capacity, 20% extra production, and he's currently making a profit. So his fixed costs have already been covered. So this extra order will utilize that spare capacity and provide him with £3,000 worth of extra contribution or profit. But we should also remember that his current UK customers find out, they may request that price in the future as well, which may affect his profits going forward. But as a one-off, Terry should certainly look to accept that order. It'll increase his profits and utilize his spare capacity. We've also got make or buy decisions. So as we know, quite a lot of manufacturers these days take their manufacturing abroad. This is one of the ways that they decide whether or not to do it. So make or buy will again look at the costs involved of production. So here we've got ASIF, who makes spark plug boots for sale to automotive manufacturers. Currently produces 10,000 per annum. A recent trade show, he's offered the chance to buy them from China. So he should do a cost comparison, which I've shown in the table here. So if he makes them himself, his labour costs are 12,000, his materials are 14,000, and he's got a variable overhead of £9,000. So he's got a total cost of £35,000. If he is to buy them in, he can buy them for £40,000. That will also reduce his fixed costs. He might be able to close part of his factory, for example. So the total cost of buying them in is just £32,000. So in a make or buy decision, all we do is compare the different costs. What does it cost us to make it? What does it cost us to buy it? Whichever one is the cheaper is the one we should probably go for. So as we can see, it's cheaper for ASIF to buy the product than make them himself. Other factors do need to be considered. If he buys them in from China, how long is it going to take to ship them across? And what's the effect of any loss of business on staff? So if he's no longer making them himself, he may have to make people redundant. He also needs to think about the quality of buying them in from China. If he's not in charge of the production anymore, is it going to be as good? So other things that we need to think about are non-financial factors when making our business decisions using the contribution theory. So we need to, first of all, think about people. How are our decisions going to affect our people? So are we going to have to train them for new skills? People don't always like being trained. They may resist new training. We also need to think about the effect of making workers redundant and employment of workers in other jobs within the business. We're also going to think about how our decisions affect places. So let's use that ASIF example again. He's buying them in from China. What's the environmental impact of suddenly shipping products over from China? Do we need to think about that? We also need to think about pollution through noise and traffic. If it gets on a boat, gets on a plane, it's going to cause pollution. Do we want that? Creation of new jobs, regeneration of the local economy, and the closing of a factory and local unemployment. So again, thinking about ASIF, if he closes his factory down, then perhaps it'll be seen as a bit of a pariah. The local community won't be very happy with him. You've got to think about the effect of your decisions on your local community. And that's it. That's marginal costing. So they're the decisions you make. Just a bit of revision there on marginal costing.